Welcome to our latest installment of ABL Advisors video series featuring thought leaders from the commercial finance industry. I'd like to welcome our guest today, Tim Stute, Managing Director and Head of Specialty Finance, Hovde Group. Thanks for being here today, Tim.
Mike, thanks for having me. It's a pleasure to be here.
Same here. I'd like to start right in today on the topic of our discussion, which is about the current state of the M&A market in the asset-based lending and specialty finance industries, and what's driving acquisitions of specialty finance companies today and how things may have changed. Tim, how would you describe the bank and specialty finance company M&A activity today versus the pre-COVID-19 crisis? In other words, how's the pipeline today compared to what it was before?
It's quite different. I mean, the market before COVID for many years had been a wonderful sell-side M&A market for all types of banks and finance companies, particularly in the specialty finance world. And we had come out of a record 2019 in our firm, started off this year with a couple of nice transactions involving ABL and factoring companies. And we came into March with really a fantastic pipeline of more sell-side M&A activity, and we felt like we were in a good spot for another great year this year. Well, fast forward, most of those deals that we were working on in early March when the world shut down are still on hold. We've been selective with some transactions that we've decided to kind of go back out and start to go to market slowly. We've started to pivot quite a bit and are working more on capital raises where you have a good company that maybe needs a little bit of a capital infusion to get through this pandemic environment. But overall, it's really dramatically different. And we've had to be, as advisors, we have to be really selective and try to be prudent with what we take on, just given the overall environment. I mean, what you have going on is for buyers, they now in this kind of environment, they want a good deal. They want to make sure that they're getting the best deal possible. They also, a lot of times, they don't know what they're buying. How can you really assess the value of another finance company's underlying loan portfolio in this unusual world that we're living in, where there's so much uncertainty? Is there going to be a second stimulus? Is there not? What happens when all of these government programs run out and these small business borrowers are all of a sudden left to fend for themselves? And are they going to be able to still make payments on their ABL deal or their factoring deal or their equipment loan? It's a big question. And then on the seller side, specifically in ABL and factoring, you have these small business borrowers that by and large got a lot of PPP money. So now you have the typical ABL or factoring company saw their loan portfolios drop off considerably, sometimes more than considerably. We've heard stories of portfolios down by as much as 50%. So you look at that, and obviously that's going to create a revenue and net income issue for 2020, perhaps beyond. But what the PPP money also did is it helped credit quality for these ABL and factoring companies, because all of a sudden the usage on lines is down and things are looking a little cleaner than they might otherwise have looked, particularly factoring in the economy shutting down. So it all adds up to just a lot of uncertainty right now and a lack of activity.
That's interesting. So that would tell me also that more than likely, as you said, that the buyers' attitudes towards specialty finance acquisitions have changed. I mean, they're looking at things differently today, and they're trying to assess how they can actually evaluate a company. And this is a big problem.
It's a problem, and yes, the buyers' attitudes have changed. They have to be more careful. I will say though that there is still plenty of buyer interest out there. We still are seeing interest from a variety of buyers, which we can get into. But when you have a company that has clearly demonstrated that they can handle this unexpected downturn, keep their credit quality in check, still maybe see a little bit of a pipeline coming back, or even growing through this part of the cycle, as maybe banks pull back a little bit, maybe others don't have access to the same amount of capital. We are seeing buyers that are looking for those types of unique opportunities where they could maybe put some capital to work, or make an acquisition of a business, knowing that, hey, I can buy a good company, maybe I can get a little bit of a better deal today, and down the road when the M&A market improves, I've got an opportunity to perhaps exit at a better valuation. So there is still there is still a lot of buyer interest. It's just it's got to be the right opportunity.
What's driving activity for acquisitions of specialty finance companies today? Are the forces that are driving any of this type of activity different than they were in 2019?
It's a good question. I would say some of the drivers are a little bit different, but many of them are still the same. It's still trying to put good capital to work and generate a good return. But I would point to two drivers that are a little bit more prevalent today. One is, unlike 2009, 2010, there's just a massive amount of liquidity out in the market, and that liquidity needs to find a home. The other is strategic desires on the part of buyers to find good add-on opportunities, kind of like I was saying a minute ago. Interestingly enough, we're not seeing a big driver in the form of distress, and I think we think that's going to change. We think as some of those themes play out that I mentioned a little while ago, with regard to a second stimulus package, a second PPP, as that whole dynamic plays through the economy, and you have things like rent payment holidays expire, SBA 7A loans that have been on a 6-month payment holiday, as some of those types of things expire, and a small business has to go back to making a full month's worth of principal and interest payments on their loan or factoring deal, that's going to end up potentially causing problems. And so we expect that there's going to be some stress there, particularly as we get into the end of this year and into next. But today it's not really there. It's more, the activity we're seeing is driven more so by buyers with still a pretty voracious appetite for assets because of their liquidity that they're trying to put to work, as well as their desire to be strategic with regard to adding on other product lines, or be able to attract good people.
Okay, and that makes sense. And we might see some of this distressed activity come back, as you said, as time passes. And that makes sense. How about the banks from their perspective? Are you still seeing banks looking to acquire commercial finance companies, or has the economic environment impacted banks' interest in ABL companies overall?
Well, it's interesting. The banks are, while their stocks overall as an industry group haven't quite rebounded the way the rest of the stock market has, they're actually one of the groups that is still calling us a lot, looking for acquisition opportunities. And that might seem a little counterintuitive, because one might say that banks are more likely to kind of recoil and be conservative. But the reality is that we're now right back into a low interest rate environment like we saw a few years ago. They're starving for net interest margin. They're starving for fee income. They have a lot of capital. They're trying to figure out how to deploy that and figure out how to find a better return than they can find in their core bank lending. We are in fact seeing banks, now I don't want to paint the picture like our phones are ringing off the hook with bank buyers, but we are seeing banks reach out saying, hey, what are you seeing in your specialty finance world? Because we want to be opportunistic and find opportunities. And by the way, I think you could make an argument, despite all the uncertainty that we're talking about in the market, I think you could easily make an argument that it might be easier for the bank to assess an underlying loan portfolio that's collateralized by receivables. You can check the quality of that third-party debtor. You can check the quality of that borrower or client of the ABL and factoring company for creditworthiness. That's probably easier to do than for these banks to assess the value of their commercial real estate portfolios right now. So I think there's an opportunity there with banks. If you have an independent finance company that has held up well and feel like you have good prospects for maintaining clean credit quality going forward, I think you're going to see opportunities from banks as buyers.
That's interesting to see that activity. What about, let's go over to the other side of the coin a little bit here, BDCs now. Let's talk a little bit about them. What role do you believe the BDCs will have in the commercial lending market? And will BDCs continue to seek diversity via the acquisition of ABL units overall?
Well, we think so. The BDCs, like the banks, they have their own credit questions that they have to answer with most BDCs, their core product really being the levered loan business. And in that market, you saw the typical BDC putting out loans in sponsor finance transactions at maybe a little higher debt to EBITDA ratio than they maybe should have been doing in certain instances. So we think some of those types of some of those situations will probably come home to roost and be issues for BDCs. But by and large, they have a huge amount of liquidity. Their investors in their stocks are only going to continue to put capital in because there's now a flight to yield in this kind of a volatile market that we've now found ourselves back in. So the BDCs, I think, are still primed to be an active acquirer of finance businesses, or even an active de novo participant in the specialty finance world as a way to put capital to work. After all, these BDCs and other types of credit funds, what they really want to do is build AUM, build assets under management. They're trying to build that base that they can collect their fees on. And what you've seen with activity over these last several years with BDCs acquiring commercial finance companies, it's also about adding product offering. So we think that's still going to be there. It's just a matter of whether there's enough BDCs that have their core portfolios under control from a credit perspective, such that they can afford to go out and distract themselves with adding on acquisitions.
Okay, great, thanks. Well, then that also brings me now to, so we've covered the BDCs, we've covered what's going on in the banking and borrowers, we've covered a number of items here. What about the analysis that you typically would go through under a due diligence that's required to complete a merger or acquisition in 2020 versus the past? Has that changed, that type of analysis? You mentioned, for example, PPP money and other things that are bringing liquidity into these companies. Has that impacted how you're analyzing and conducting the due diligence in these opportunities?
Well, yes. I think the core analysis that a buyer, whether bank, BDC, or otherwise, the analysis that those groups are doing in looking at an acquisition, on the whole, it's not materially different. It's still driven by what's my return, what's my internal rate of return, what's my return on equity that I'm getting for writing this check to make this acquisition. That's still at the core of what a buyer is going to do. But I think where you see a change is so much of the analysis that a buyer does in any M&A transaction is focused on the future. It's focused on making assumptions and running those assumptions through a returns model, projecting income statements and balance sheets and figuring out what the bottom line returns are at different acquisition prices. I think today, and we have a couple of transactions we're working on now as a buy-side advisor. I think today we have to advise our clients on the buy side that they have to be extra conservative in those assumptions. I mean, it's a pretty obvious statement given the uncertainty that's out there in the market, but we think you have to really dial back growth assumptions. You maybe have to dial up credit loss assumptions. We think you have to be careful with assuming too much of an expansion in yield on loans. But overall, it's the same type of analysis that folks have always done. And I think there's also I think with any credit business, there's always going to be a focus on underlying loan portfolio concentrations, and obviously now that's even more relevant. You know, if you've got a business that's heavy on retail concentrations, you've got a business that's heavy on the entertainment sector, hotels, any of those kinds of pretty obvious asset classes, that's obviously going to take a pretty, you're going to need to bring a scalpel to that due diligence to make sure you're really, you know, looking in the closets to see where the skeletons might be buried.
Okay, great. So that brings me sort of to another question that has to do with that underwriting part of it, and that is that beyond the solid foundation of financials and all the other items that you're looking at in due diligence, what about the experience and depth of the team of the management today? How important is that? Are companies really looking to see companies that have weathered the storm in prior downturns and looking to see if management has the experience, specifically management, to do this?
Most definitely. I mean, I would tell you that in my years of doing this, I think the quality of the management team is always going to be the number one value driver. I don't care what part of the cycle we're in. I think the breadth and depth of the team is just mission critical. We, even before we got into this pandemic world, we really had several buyers that we do a lot of business with, that they would actually say, "Hey, Tim, thanks for sending us this opportunity. It's interesting, but because they weren't around during the Great Recession, and we therefore don't know how they handle stress in the portfolio, we're going to take a pass." So I think now, when we're sitting here right now in the middle of this thing with all these unknowns in the future, I think that's going to be a major point of emphasis for any buyer or investor in a commercial finance company. Have you been there, lived through this, survived it? You can talk about it now, and you have lessons learned that you can be applying as you go forward here. I think that's absolutely top of the value driver list.
Okay, well, that makes obviously logical sense in today's environment more than ever. And I'm going to wrap it up with the final question, and that's for an outlook. I have to ask you for an outlook, and that's saying basically, what's your outlook for M&A activity as we get through the end of 2020 into 2021? What do you think is going to be happening out there?
Well, I will. I wish I knew. I think, and I'll ignore, for purposes of this question, I'll ignore the obvious, elephant in the room with the election and who knows what's going to happen there, and some of the government stimulus programs that I keep talking about. I would say that I think it's a pretty safe assumption that as we go through the rest of this year, I think we'll continue to see a handful of M&A announcements. There have been only a couple, but a few announcements since March of acquisitions that have occurred specifically in the ABL and factoring space. I think you might see a couple more of those types of announcements as the year progresses here. You're going to see that in those deals, there's a very clear strategic rationale as to why that buyer has lined up a transaction with that seller, I think it's gonna make a lot of sense because of that strategic bend that I talked about earlier. But I think as you go into 2021, I'm very confident that there's going to be a clear uptick in M&A activity. I really believe it, and part of it's because of what we talked about with the likely coming of distress hitting the market, and banks needing net interest margin and fee income, the BDCs looking for assets, asset growth and products. But I also think that there's strategics out there like other finance companies that maybe in order to appease their shareholders and survive and thrive going forward, we think they're going to need to look at some of their peers as a way to kind of combine and shed the fat to improve the bottom lines, particularly as we wait for the assets to come back up in the wake of PPP. So I think you'll see more of those types of finance company to finance company type of transactions. And then I also think you have sellers that had thought that 2020 was their year. That was when they were gonna exit, and all of a sudden this happened, and you're gonna get into 2021, and if things are relatively stable, particularly with a particular seller in question, I think they're gonna say, you know what, we don't want to wait any longer. Let's go try our hand and get out there in the market, and we just don't want to wait any longer. So I think overall, we feel good about the market starting to return to more pre-pandemic levels, particularly as we get into next year. I think it's just going to be a question of deal pricing and valuation. We think that premiums are attainable, and we think they're attainable now. We think they'll be attainable next year. It has to be a company that has that team dynamic that we talked about, where they've been there, done that, lived through a downturn before. It needs to be ideally a group that has a unique, something unique, a niche focus, a unique origination strategy. Just a fantastic credit quality going back to the beginning of time, something that can really justify a buyer saying, you know what, this is something I'll pay up for even in this unique environment because I'm buying into what these guys are bringing to the table. So we've spent the last 6 months pivoting a bit, like I said at the beginning, into doing more on the capital raise. We've had some portfolio sales that we've done. We're trying to find ways to still generate deal flow and close transactions. I think as we get through the rest of this year and into next year, we'll be able to go back to what we're known for, and that's mostly M&A transactions.
Well, that's a great positive note and a good way to wrap up the interview, Tim. We can look forward to hopefully seeing what you just said come to fruition. And, with that, I would like to wrap up the interview and just tell you thank you very much for your time and your insights. Your credentials are unquestionable, and everyone knows that you are an expert in this field. So I really do appreciate you taking the time to speak with me and with our readers, and to present your thoughts on what's happening in the marketplace. And we'll be back to catch up with you again at some point in the future as well.
Sounds like a plan, Mike. Thanks for having me, and anytime.
Pleasure is ours. Thanks, Tim. Have a good day.